Ladies and gentlemen, welcome back to the channel. I need you all to focus in, lock in on what the next 6, 12, 18 months can do here for your future. We are heading into an opportunity unlike anything else. If you think you've seen anything yet, you are wildly mistaken. Okay? We have not seen a lower interest rate environment in this AI cycle thus far. We have not. 2021, AI wasn't even a thought process for investors. We're heading into something that could look like that. A super cycle for AI. I've talked about this on the channel before, and I know I'm really early, but that's where the money is made. In this video, I'm going to share with you my perspective on just why I'm so bullish over the next 6, 12, 18, 24 months. How I think, or why I think, this could be your opportunity to make your millions. Yeah, I know I said it. To become a multimillionaire. This is not an opportunity you get every day. I want to be very clear about this. Some investors wait decades before they have an opportunity like this that is setting up. I mean, it's almost like if you watch football or something and you're watching a play and it's like, you know, a critical play. It's fourth down. They got to get it. And you see it line up, right? You almost know it's going to work. Okay? That's where we are right now. All the stars, if you will, are starting to align for this one outcome, and that is massive gains in your portfolio. Yes, it's all lining up. So here in this video, we'll discuss that. We're also going to take a look at what Dan Ives said yesterday about the tech trade that is just getting started. And yes, I do want to share with you a clip from Warren Pies. I actually shared it in the last video as well, so if you've seen it, feel free to skip over it. But I think he's got such a great perspective on this. He's been so incredibly correct in 2025 so far that it would be a discredit to you to not share that clip again, to make sure everyone possibly sees it. He was the first guy back in January, February saying, hey guys, we're going to have a little bit of trouble in March and April and maybe May before we have a strong second half of the year rally. And what he's saying specifically in regards to small caps and AI is critical. Now, what's also mission critical, I think, is Tesla. Tesla, I do believe, will grow to be the epicenter of this AI trade. Okay, because we used to talk about this a lot more. I think it's going to become incredibly more important. But really 2023, the second half of 2023, when the AI, euphoria started, the first round, if you will, through 2024, up until the last couple of months ago, the AI trade was focused on the AI enablers, right? The semiconductors, the storage names, things like that actually make AI possible. That's fair, okay? The next round of the AI story is the AI appliers. It is the software companies that are taking large language models or, data that they have trained to do a specific task and actually applying that to the B2B world, the business to business world, or business to consumers, or B2C, business to consumers software. Okay. That's a big theme. But I think the biggest holy grail of AI, as Tim Cook said back in 2017, is self-driving cars. Because why? It is the largest market in the world. Everyone has a car. Everyone drives. People die in car accidents. Okay, let me put it like this. If you want to get incredibly wealthy in your lifetime, not like, couple $100 million, but like couple $100 billion, billions of dollars, think about money in terms of value, okay? If someone makes $1 million a year, there's one difference between that other person that makes $30,000 a year, okay? And this is the hard truth that a lot of people need to face. It's value. The guy that makes $1 million a year provides more value. The guy that makes $1 million a year either, let's say makes YouTube videos that shares insight, that helps make people money. That guy provides more value, unfortunately, than the guy that bags groceries at Kroger's or Walmart that makes $30,000 a year, okay? Whether it's Mark Zuckerberg or Elon Musk or, Bill Gates or, the Arnolds or whoever it is that is worth a lot of money, they have provided a lot of value, okay? So when you think about your AI investments, a big chunk of that should be what provides the most value. What provides the most value will be the most successful. With good execution, good management, all of that. You got to cross your T's and dot your I's and all of that. But that's a big theme. So it's the AI appliers. It is the holy grail of AI, which is self-driving cars. I think that's why Tesla is going to be at the epicenter of this AI euphoria that I see coming. Why you don't want to discredit Tesla now, even though Tesla has fallen in the last couple of days as markets have hit new all-time highs. The big question is, as I've said before, when do we get the answers around scalability? That is the only thing that matters for Tesla stock at this point. We just seen, again, I want to reiterate for the third time now, probably the last time, Xiaomi, I'm not sure exactly how to say it, so bear with me. Xiaomi, I think, is what people have told me down below in the comment section. The smartphone maker in China, now turned EV maker as well. They announced 200,000 pre-orders for a direct competitor to the Model Y in 3 minutes. 6 months ago, that would have dropped Tesla stock 5%, 7%, 10% maybe. On Friday, you were down less than 1%, including the move in regular trading and in after hours. And for a good chunk of the day, Tesla stock was actually in the green for periods. Okay? That is a different Tesla than you had a month ago before the robotaxi launch. And as we get clarity on scalability, deliveries are going to matter a lot less. I used this analogy before because I think everyone understands this. But when Apple reports earnings, people care about two things. And really only one thing. They care about iPhones and they care about services. You could have Macs and wearables and all of the other subcategories do very well. But if iPhones miss a lot, that's 50-50 whether that's going to drop the stock. But if services miss, even by a little bit, that's almost always going to drop Apple stock. Now, if iPhones miss, if everything else misses, but services come in with a strong beat, the stock's going to go up. Okay? That's kind of like Tesla at this point. I think the deliveries are going to matter a lot less, and it's going to be about that AI category. And I think Tesla is going to start reporting their AI revenue separately, which is going to be great. Like, what if we can look at Tesla's next quarter earnings and say, hey, or, Q3 or Q4 and say, hey, the auto business shrank 2%, but the AI business is growing 200%. Wall Street's going to start to pay more attention to that AI business and say, hey, what's profitability going to look like down the line, so on and so forth. And with the massive market that robotaxi has, the growth, you can't really limit it. It's going to be here for many, many years. So that's one reason specifically I'm bullish on Tesla, but I'm really bullish on the small cap AI area as well. Small caps, generally speaking right now, a lot of them are overlooked and underappreciated. Why? Because we've been in an interest rate environment that has been high for a long time. Yeah, we've had AI, optimism around the AI enablers. Most of the AI appliers are still underappreciated as well, let alone the small cap AI enablers. Those guys are long forgotten about. But I think on a risk-adjusted basis, with those stocks being down so much, I think that's where a lot of the opportunity is. We just invested in one that I think is a good 5 to 10xer in the next 6 to 12 months. If you guys want to check out the due diligence that I am doing every day, spending hours going through small cap stocks, trying to find the next big AI winners, check out that link down below in the description of this video. That is the real service I think I can provide right now to give the most value to people, is what I'm doing in my portfolio, going through those small caps, sifting through the bad ones in the bad industries that aren't growing and finding the ones in the good industries that are growing, that are disrupting markets in their respective categories. Okay. That is where I see the most opportunity. That is how I am investing my portfolio, and I'm sharing that journey with you. And you couldn't convince me that it's the bad route to take here. Unless something dramatic happens, unless we go into a recession, unless there's hyperinflation or, nukes go off or something, I'm confident that I am going to be correct, and this strategy is going to massively outperform. It already is. Let's be honest. It's already, showing some incredible results. And it has for a while. I mean, we invested in APLD before anyone really talked about it at $3 a share. Today, it's like 12. It went up to 15. We invested in Nebius Group, AI data center name, at $17 to $22. That stock's in the 50s right now. We invested in Novartis Semiconductors in the $2 range. That stock's like $7, $8 now. Okay. That was all in the last 6 months, but we've come across a lot of other big winners as well, some of which have already started to do very well, but are still down like 70, 80% from all-time highs. Like, even though you might have got a 50% return since we bought some of these AI stocks, they're still down massively. And I think the potential is just getting started. So check that out if you guys have not already. Link down below in the description of this video. But kind of the core of what I'm getting at here is we are heading into the next 18 months where we're going to see upwards of 8 to 9 rate cuts in a market where we're going to be focused more than ever on AI. At a time in which a lot of AI stocks are not being fully appreciated, where there's a lot of diamonds in the mud, if you will. And I think that's where the opportunity is. And I think Tesla is, again, the epicenter of that. If you look at total addressable market, if you look at, the AI endeavors that Tesla is pursuing, if you look at what Wall Street has been focused on in the last 4 years, which is solely the, car business that Tesla provides, they're not focused on the things that really matter. And as that focus shifts, as Tesla scales the robotaxi to be bigger than Waymo next year, that's going to be all of the attention. And I think expectations will be that Tesla is going to become a lot more profitable than it is today in the coming years. As rates come down, Wall Street will look out further and start to look at 2030 and say, what's Tesla going to look like in 2030 with its AI endeavors? And I think that's where some of the expectations can start to get pretty crazy. And that's where the real upside comes in Tesla stock over the next 6, 12, 18 months. So that's kind of my perspective here. That's how I'm investing my portfolio. Unfortunately, I'm not interested in the stocks like McDonald's right now, 7%, 10% EPS growers. That's not the environment we're in. Eventually, there will be a moment for those large names again. And I'm sure they'll do well in this market. I'm not looking for the 20%er. I think we all are here because we want to get rich. We want to make a lot of money. Okay. When there is opportunity, you seize it. Okay. What I'm saying here is I could be wrong. There's a chance of that. Like, I'm not a financial advisor. I'm not a financial planner, but I think now is your opportunity. Now is your opportunity to look into the future and to see where things are going. I tell people all the time because nobody I know invests their money. Like, I am the oddball. I'm the weirdo that, puts thousands of dollars into the market every month. Okay. In different sizes, different portfolios. When people ask me, like, how do you know what's going to be a good stock? I say, well, you never really know. You could do your due diligence. You can know more about a company than you do your wife, right? You can do all these things. There's a certain aspect of risk and luck that are to play here, okay? But you can massively tilt the favor in your favor, or the balance in your favor, by understanding where markets are going. That's what I've kind of specialized in over the last 10 years I've been investing, is to spot trends early and to get on board of those trends early. Now, this one is bigger than anything you've ever seen before, because it's going to change things more than you've ever seen before. Elon Musk just said today that he thinks this country could have a surplus in the next 10 years. I mean, that's crazy. Peter Thiel, one of the early, investors, kind of partially founders of Facebook, multi-billionaire, says that AI is going to add 1% to GDP for the next 10 to 15 years straight. You've never seen anything like that before. And what's going to actually do that is the AI enablers, the companies that enable those kind of productivity gains to give you 1% GDP growth for 10, 15 years straight. Like, that is unheard of for a $35 trillion economy. That is like fairy tale shit in investing land, okay? Whether that's right, half right, 25% right, you want to be invested in that. You've never seen anything like that before. But again, back to what I tell people. As an investor, the investors that really do well can predict the future. 10% of the future. If you are even, able to predict 10% of the future, or 10% of your stocks are right in your projections for the future, you will get incredibly rich. I think it's easy to say certain stocks are going to be much bigger in the future than they are today. With the environment that we're heading into, that is going to be supersized. Like Tesla. We all know Tesla is going to be a huge success with AI, but the markets are going to start realizing that. And that's where the big gains come from, in portfolios. So I want you guys to take a listen to these two clips. Ladies and gentlemen, enjoy your weekend. That's it. I will see you in the next one.
With stocks at record highs, what is the best way to play the markets into the second half? Let's ask 314 Research's Warren Pies. It's good to see you. What's the first thing that comes to your mind? I mean, I feel like the market doesn't have a care in the world until it does, but today, even with a little bit of a pullback off of a trade headline from the White House, doesn't seem to be doing all that much.
Yeah, thank you for having me. I mean, it's easy to say that on a day like this, but we've built quite a wall of worry, I think. So we've been telling our clients to stay bullish. We look out at the second half, and I think the first half was really defined by a bunch of events. And 1 week we're thinking about tariffs, the next week we're thinking about going to war with Iran potentially, and it's really, I think, created this wall of worry, all these events. But when we zoom out and look at the market and think and ask ourselves, where have we come from the beginning of the year? We've basically consolidated. When you take all that stuff away for a minute, forward earnings are at an all-time high, which is unequivocally positive for the market. And what we've had is a sentiment reset. So we came into the year with the 6,800 target on the S&P 500. Our big concern was sentiment. We thought we needed a 10% correction in the first half to reset sentiment. And we see that now. Strategists have dialed down their targets, and I think we're clear sailing, at least as much as you can be in these markets for the second half.
Are better earnings than expected? Is that what at the end of the day will define the second half in the market? And in some respects, it has to, correct?
Yeah, I mean, I think that's the bet, right? We've brought estimates down a bit. I think there's some concern around tariffs and how those tariffs flow into earnings, and I think it's actually given us, oddly enough, kind of a lower bar for the S&P to jump over. So, yeah, I think earnings should be okay. I mean, our concern, our biggest risk, and we listed all the risks in our H2 outlook for clients, is really the economy, which obviously indirectly you're not going to grow earnings if the economy falls into recession. And so that's where we're focusing most of our attention. But for now, I think we're in the same kind of muddle through soft landing environment, and I think S&P earnings are going to surprise to the upside.
So what does the playbook look like then, if we believe what you say and it actually comes to fruition? Where do I get the most out of that?
Yeah, I mean, I think we're going to stick with high quality stocks. So one of the things that we've noticed, if you're going to pick nits in the market right now, breadth is kind of weak. So we've got the market at an all-time high. The median stock within the market is still like 13% off a 52-week high. We did a bunch of analysis on that. That's odd historically. But what we found is that that's really happened a number of times in this bull market because we have this mega cap led bull market. So if we're going to advance to this like another 10% in the second half or something like that, you've got to get participation outside of just this very narrow mega cap world. And I don't think I'm not talking small caps or mid caps. I'm just saying within the S&P 500. So I like high quality still. I think we're going to broaden out a little bit. Still going to be mega cap led. I think I do think oil is going to be weak in the second half. That should be a tailwind in the market, but you want to stay away from some cyclical commodity producing stocks. And I think bonds are going to be okay. I think that the consensus was so concerned about bonds coming into the year, and this is something you and I have talked about over the months. Mm-hmm. And our view is that rates were going to fall. And so I think that's a kind of a nice mix for assets in general. Don't go crazy getting low on the quality spectrum, though.
But it's interesting because people are doing just that. And whether it's you or others who consistently come on the network and say high quality, stick to the better, the biggest. If you look at the high beta stocks, the high beta ETF, for example, and lower quality names, they're doing incredibly well. What's the message or the risk in that?
Well, a part of that is normal off of a market low. Beta is like the number one factor when you make, and we put in a pretty significant low. When we look back at this, it was a fast rebound, but we were down almost 20%, basically a bear market. So, traditionally, as much as it feels weird, traditionally, this is what you would expect to see high beta lead. I think the next stage of the bull market kind of by definition has to broaden away from that group though. And so if you ask me how to rotate your portfolio, I think some of these underperforming quality names that have been kind of forgotten about in this crazy speculative run, that's where we're going to get the most bang for our buck, the best risk adjusted second half return.
Because some say it's classic late cycle FOMO moment when you see that performance from lower quality, higher beta.
Yeah, I mean, to me, I would push back against that a little bit. When we study cycles and factor performance, actually low quality leads off market lows, and we had a market low. I think this is part of that wall of worries that you have a pretty big consensus that doesn't recognize the event that we just went through. We went through a real important clearing event where we came in over optimistic. Maybe I think more of what we saw around the peak in November, where we had small caps, people were trying to buy small caps and stuff like that after the election, that looked like toppy behavior to me. And now what we've had is a washout and no one wants to believe what's happening. But in fact, I think this high beta leadership is a little bit like what you'd see off of a major market low. And so that tells me that we're still, as crazy as it sounds, like maybe in mid innings for this ongoing bull market.
Wow. All right. We'll leave it there. Warren, thanks. We'll see you soon.
Dan, I guess the big question everybody wants to know is how much life is there in this rally?
I think this is just starting in terms of this next stage of the AI revolution. And I think as we go into the software phase, you see on the consumer side when it comes to AI, I believe this is still bottom of the first, top of the second inning. And that's why NVIDIA, 4 trillion, ultimately 5 trillion. Microsoft, we think on the road to 4 and then 5 trillion. It's our view, this tech bull market, get the popcorn out. I think it's going to be a very strong second half.
There's only been a lot of talk about the big structural changes that AI is bringing, not only to the companies themselves, but potentially to the economy and to the markets. You're also seeing sort of a similar sort of run for the gold going on right now in the autonomous vehicle space. And there were just some headlines a while ago out of the New York Times that Uber has actually tapped its former CEO, its co-founder, Travis Kalanick, to potentially fund a deal to buy a company called Pony AI, which makes autonomous vehicles, the U.S. arm of Pony AI, I should say, that helps to make autonomous vehicles. I do want to get your thoughts on that deal and about the amount of money and effort that these companies are spending to get ahead in this self-driving ride-hailing space.
Look, that would be the smart move for Dara, and I think there could be more behind it. Because when you look at the next phase, when it goes to physical AI, it's about autonomous. And Uber, when you look at Tesla shot across the bow, everything we saw in Austin, that's now started to play there. Uber needs to definitely focus on partnerships and expanding their repertoire when it comes to autonomous. This would be a smart strategic move, aggressive if they did it.
How important is that first mover advantage that Tesla and that Waymo currently enjoy?
Yeah, look. First mover advantage is important in terms of Waymo, but the reality is those are $230,000 cars in 4 to 5 cities. It's all about scale. That's what Tesla's going after. And that's why Uber, they can't just sit there and Darren knows this on the treadmill. They're going to have to aggressively focus on their fleet and what they could do when it comes to autonomous. And I think that's going to be the next chapter when it comes to AI, but it speaks broadly to our view of tech, from robotics to autonomous to enterprise to consumer AI across the board. I mean, this is, I believe it's a golden age for tech.
So when it comes to funding something like this, how much are investors going to be comfortable with that without seeing a return on investment in the immediate near term? Because that was a question when it came to building up the AI data centers and the AI capabilities. And at some point, investors were willing to give the companies the benefit of the doubt until it became clear that the spending wasn't resulting in anything tangible.
Yeah, and then obviously you start to see it come through, and that's why the last thing investors want to see, you don't want to see them on the outside looking in. I think that's why Apple's underperformed, right? Because the reality is, when we were at WWDC, the AI strategy, right, it was kind of a shrug the shoulders. Investors right now know this is a Game of Thrones arms race that's going on when it comes to AI. Stronger going to get stronger when it comes to tech. But that's why look what's happened with Nadella and Redmond. They're just getting stronger and stronger when it comes to AI because they recognize where the next steps are. That's look at names like Palantir, the Messi of AI. It shows this is not stopping. Tech needs to continue to spend.
I am curious, Dan, how you value these companies. I know there's been a lot of talk about how traditional valuation metrics and multiples don't necessarily apply, at least to some of these companies, don't necessarily apply in the same way that we have in the past. But of course, that doesn't stop the bears and the naysayers from looking at those traditional multiples and saying, look, I mean, there may be a future here, but at least current pricing seems to suggest that some of these stocks are way overvalued.
Yeah, and look, the haters, I mean, they'll sit there, those bears sitting in the hibernation caves, right? They can't find AI in the spreadsheets. But it's our view. You have to look out 3, 5, 7 years what the monetization opportunities looks like. If you believe on the consumer side, the next stage of AI, then Meta is a 4-digit stock. But it speaks to my view that if you just focus on 1-year valuation, you miss every transformational growth stock the last 20 years.
You mentioned Meta as a winner here. We're paying attention to Uber. What's a company that people are not paying enough attention to that could be a stealth winner here?
I mean, I think it's IBM. I think there's a renaissance that's happening at IBM in Armonk. I think Arvind's doing a great job, and that's further and further monetization. I think institution that's still very underowned, taking a page out of Microsoft's playbook, and I think it just shows you're now seeing tech spread to the second, third, fourth derivatives. That's why we have our Ives AI 30. It's not just about 2, 3 names. Of course, it's led by Godfather of AI, Jensen, NVIDIA, but it's spreading to the rest of tech. And that's why it continues to be 10 p.m. in the AI party that goes to 4 a.m.